Hey guys, so today we're gonna analyze CSX, which is another major railroad company in North America. This is one of the six main companies that we checked out last time. And as we can see in the yellow here, this company covers the east coast of United States with just one another company. Looking at their coverage in more detail, they cover all the major ports in the east coast, as well as in the central area from Detroit and Chicago down to New Orleans in the Gulf of America, as well as the Florida region. So on top of the intermodal, which is container and coal, they carry diversified merchandise through their rail network. And just like CNI, some products will do well in one year and not in the other. So overall, the company is well balanced out by its diversification. And this is the high level picture of what happened in the past year. The volume increased by 2%, but revenue decreased by 1%. And although operating income decreased by 3%, the EPS was pretty stable at $1.83 per share. So overall, very similar to CNI, and its high quality is also shown in this ROE graph. So its 20-year average ROE is 21.9%, and 10-year average is even higher at 26.5%. And despite the good performance, its stock price has been pretty stagnant over the past 4 years. And the bull and bear thesis is quite similar. It's Buffett approved high quality with proven track record for the past decades. And CSX is also invested by three super investors but had flat price for the past 4 years. Bears would argue that it's still too expensive, PR of 17 times and dividend yield of only 1.8%, and more recently the revenue and profit has been sluggish, as well as recession worries, which will impact railroad companies directly. And we'll cover the financial statement analysis very quickly because it's very similar to CNI situation. The ROIC level is at about 15% per year, and the company is growing its equity base, which is followed by the increase in net income, which is very healthy pattern. Its revenue in blue and EBITDA in orange are also increasing very well. And also the EBITDA margin increase indicate that the efficiency of the company is also increasing as the company grows. And the long-term CAGR shows that in the past the CAGR number looks stronger, but more recently the company is struggling a little bit. But just like CNI last time, railroad companies do get impacted by economic difficulties like 2008 financial crisis and COVID era. But overall, the company was able to juice out growth through this period. And this can be very evident in the EPS trend for the past 25 years. And the company continued to increase its asset base, which is fine because the company's cash flow and income also increase accordingly. And if we break down the 10-year cash usage, the company generated about $30 billion in operating cash flow and spent about $12 billion in capex. And it paid about $5 billion in dividend, but more importantly, spent $18 billion in the buybacks. And the gap here was closed by $4 billion of net borrowing. So CSX also increased its debt over the years, but if you look at the debt multiple, it's actually falling from above 4 times to at 3.6 times currently. And just like CNI, this was to take advantage of falling interest rate, so they can borrow at 4% and invest at 15%. So that's good for investors. And its DPS growth has been pretty stellar. For the past year, it only grew at about 9% per year. However, for the past 20 years, it grew at 16.6% per year. And what's noticeable is that the payout ratio is only at about 27%. So despite such growth in the DPS, the company still pays out only about a quarter of its income to investors. And that was possible because the company repurchased its shares very aggressively. As we can see here, in the green bar, the dividend is quite small compared to the repurchases shown in the red bar here. So since the company bought shares so aggressively over a very long period of time, the number of shares is decreasing quite significantly. And again, for such aggressive buyback, valuation is very important. And good news here is that as I run this DCF number, we can expect about 11% of IRR. So throughout the years, the company repurchased shares at expected IRR of around 10%. So it's not great, but at the same time, we can see that it was a reasonable decision. And if we run the sensitivity analysis, in order to get the 15% IRR that I usually aim for, the stock needs to fall about 20% further from the current price. But compared to the CNI we researched last time, it's in relatively good position at current price. So overall, it's very similar to CNI. So today, we're going to take a step back and check out why railroad investing can be good in a very long spectrum of time. Here on the right, I organized the US GDP data in 2023 US dollars since the 1950s. So it started at 3 trillion and most recently is at 42.7 trillion. So it increased over 14 times over that 70-year period. As the economy grew, the total shipment in terms of the weight increased as well. So as you can see here, in 1950 there was 5.7 billion short tons that moved within the United States. But in 2023, that number grew over 3 times. And the increase was more steep in terms of import and export. So as the US GDP grows, we can expect the total weight of materials that moves within the North America also increases. And since these railroad companies are very efficient at moving very high load of goods, they can benefit from this long-term trend. This is another way to look at the number. So here, I researched the total trade value between US, Canada, and Mexico for the past 20 years. And it increased from 3.3 trillion to 9.3 trillion. So in terms of dollar value as well, there is a clear trend that the trade volume increases, which benefits the railroad companies. So on top of this good fundamental, we can add what Chuck Acre have said about the long-term compounders. So he said, in order to get good return from long-term compounders, we need to get about mid-teens ROE and not pay more than upper teens multiple. And this is exactly what CSX is at. So it creates about 20% ROE for a very long period of time and has about 16.5 times PE ratio currently. In terms of the three legs tool, we can focus on the reinvestment side. So it needs a long runway, which we just checked out through 2 tables, and we also need high incremental ROIC. So I did a further numbers analysis. This is the CNI case for the past 25 years. And about 10 years ago, the company generated about $2.4 billion of profit per year, and now generates about 3.8, which means there has been about $1.4 billion of increase. And in order to generate this incremental profit, the company invested about $11.5 billion in growth capex. So if we divide 1.4 by 11.5, we can get about 15% of pre-tax incremental ROIC, which checks with the requirement for long-term compounders. We can run this number for other companies as well. For example, here I ran it for BNSF, which is controlled by Berkshire. And here the calculated ROIC is about 14.3%. So all the major railroad companies generate about 15% of ROIC from investing into the future. And they have long runway ahead of them. So they all check the boxes to be the long-term compounders. And this is the reason why they invest so much of their cash flow into the capex. And we can break down the capex through maintenance as well as growth capex and do the calculation that I just showed you and reasonably expect that the long-term growth to continue into the several decades ahead of us. And finally, let's see if investing in CSX today is a good timing. So historically, as you can see here, for the past 25 years, the average multiple has been a little bit lower than current 13.7 times. So the stock needs to fall additional 8% in order to reach the historical average. And in terms of EV/EBITDA, the stock needs to fall additional 9% to reach the historical average. And finally, in terms of PE ratio, the company is actually at near the long-term average. So overall, the current multiple is not extremely expensive, but at the same time, they're a little bit higher end in terms of long-term average. So depending on your preference, you can wait for the stock price to further before start investing in it. Okay, so that sums up our quick analysis on CSX today. And if you guys are interested, please leave a comment below and I will share my analysis on CP, Canadian Pacific, which had an interesting merger recently and maybe an interesting investment case. Okay, thanks for watching today. I'll see you guys in the next stock analysis.